Hello and welcome to How to Econ. This video is about government budget and fiscal policy. We begin with an overview of US government spending and taxes. We then discuss fiscal policy from a short-run perspective, that is, how government uses tax and spending policies to address recession, unemployment, and inflation, how periods of recession and growth affect government budgets, automatic stabilizers, and practical problems with discretionary fiscal policy. Government spending covers a range of services that the federal, state, and local governments provide. When the federal government spends more money than it receives in taxes in a given year, it runs a budget deficit. Conversely, when the government receives more money in taxes than it spends in a year, it runs a budget surplus. If government spending and taxes are equal, it has a balanced budget. Each year, the government borrows funds from US citizens and foreigners to cover its budget deficits. It does this by selling securities like treasury bonds, notes, and bills, and it promises to repay with interest in the future. The interest payments on past federal government borrowing are typically between 1 to 5% of GDP in the United States. We need to clarify the difference between the deficit and the debt. The deficit is not the debt. The difference between the deficit and the debt lies in the time frame. The government deficit or surplus refers to what happens with the federal government budget each year. The government debt is accumulated over time. It is the sum of all past deficits and surpluses. For example, if you borrow $10,000 per year for each of the 4 years of college, you might say that your annual deficit was $10,000, but your accumulated debt over the 4 years is $40,000. In the US, the 4 categories national defense, social security, healthcare, and interest payments account for majority of all federal spending. The rest of federal government spending covers all other categories such as international affairs, science and technology, natural resources and the environment, transportation, housing, education, income support for the poor, community and regional development, law enforcement and the judicial system, and the administrative cost of running the government. The federal government does not have balanced budget laws. All states except Vermont have these laws, which means any gaps between revenues and spending must be closed by higher state tax, lower spending, drawing down their previous savings, or some combination of all of this. When most people think of federal government taxes, the first tax that comes to mind is the individual income tax that is due every year on April 15 or the first business day after. The personal income tax is the largest single source of federal government revenue, but it still represents less than half of federal tax revenue. The second largest source of federal revenue is the payroll tax, captured in social insurance and retirement receipts, which provides funds for Social Security and Medicare. Payroll taxes have increased steadily over time. Together, the personal income tax and the payroll tax accounted for about 80% of federal tax revenues. The income tax is a progressive tax, which means that the tax rates increase as a household's income increases. Taxes also vary with marital status, family size, and other factors. At the state and local levels, taxes have been rising as a share of GDP over the last few decades to match the gradual rise in spending. The main revenue sources for state and local governments are sales taxes, property taxes, and revenue passed along from the federal government. But many state and local governments also levy personal and corporate income taxes, as well as impose a wide variety of fees and charges. The specific sources of tax revenue vary widely across state and local governments. Some states rely more on property taxes, some on sales taxes, some on income taxes, and some more on revenues from the federal government. The marginal tax rate is the tax rate an individual would pay on $1 additional of income. In other words, it is the tax percentage on the last dollar earned. In 2021, the marginal tax rates for a single taxpayer range from 10 to 35% depending on income. Here is a quick example. Suppose that a single taxpayer's income is $35,000 per year. Also, suppose that income from $0 to $9,075 is taxed at 10%. Income from $9,075 to $36,900 is taxed at 15%. And finally, income from $36,900 and beyond is taxed at 25%. Since this person earns $35,000, their marginal tax rate is 15%. The key fact here is that the federal income tax is designed so that tax rates increase as income increases up to a certain level. The payroll taxes that support Social Security and Medicare are designed in a different way. First, the payroll taxes for Social Security are imposed at a rate of 12.4% up to a certain wage limit. Medicare, on the other hand, pays for elderly health care and is fixed at 2.9% with no upper ceiling. In both cases, the employer and the employee split the payroll taxes. An employee only sees 6.2% deducted from his or her paycheck for Social Security and 1.45% for Medicare. However, the employer's half of the taxes are probably passed along to the employees in the form of lower wages. So in reality, the worker pays all of the payroll taxes. We call the Medicare payroll tax a proportional tax, that is, a flat percentage of all wages earned. The Social Security payroll tax is proportional up to the wage limit, but above that level, it becomes a regressive tax, meaning that people with higher incomes pay a smaller share of their income tax. The third largest source of federal tax revenue is the corporate income tax. The common name for corporate income is profits. Over time, corporate income tax receipts have declined as a share of GDP. The federal government has a few other smaller sources of revenue. It imposes an excise tax, that is a tax on a particular good, on gasoline, tobacco, and alcohol. As a share of GDP, the amount the government collects from these taxes has stayed nearly constant over time, roughly between 2 to 3% according to the Nonpartisan Congressional Budget Office. The government also imposes an estate and gift tax on people who pass large amounts of assets to the next generation, either after death or during life in the form of gifts. This estate and gift taxes collected less than 1% of GDP. Other federal taxes, which are also relatively small in magnitude, include tariffs the government collects on imported goods and charges for inspections of goods entering the country. In a country, a central bank can use its powers over the banking system to engage in counter-cyclical or against the business cycle actions. If recession threatens, the central bank uses an expansionary monetary policy to increase the money supply, increase the quantity of loans, reduce interest rates, and shift aggregate demand to the right. If inflation threatens, the central bank uses contractionary monetary policy to reduce the money supply, reduce the quantity of loans, raise interest rates, and shift aggregate demand to the left. Fiscal policy is another macroeconomic policy tool for adjusting aggregate demand by using either government spending or taxation policy. Expansionary fiscal policy increases the level of aggregate demand either through increases in government spending or cuts in taxes. Graphically, this shifts the aggregate demand curve outward or to the right. Contractionary fiscal policy decreases the level of aggregate demand either through cuts in government spending or increases in taxes. Graphically, this shifts the aggregate demand curve inward or to the left. Let's take a closer look at each situation. Expansionary fiscal policy increases the level of aggregate demand through either increases in government spending or reductions in tax rates. Expansionary policy can do this by, first, increasing consumption by raising disposable income through cuts in personal income taxes or payroll taxes. Second, increasing investment spending by raising after-tax profits through cuts in business taxes. And third, increasing government purchases through increased federal government spending on final goods and services and raising federal grants to state and local governments to increase their expenditures on final goods and services. The aggregate demand, aggregate supply model is useful in judging whether expansionary or contractionary fiscal policy is appropriate. Consider this situation on the screen, which is similar to the US economy during the 2008-2009 recession. The intersection of aggregate demand AD0 and aggregate supply SRAS0 is occurring below the level of potential GDP, as the long-run aggregate supply curve indicates. At the equilibrium E0, a recession occurs and unemployment rises. In this case, expansionary fiscal policy using tax cuts or increases in government spending can shift aggregate demand to AD1, closer to the full employment level of output. In addition, the price level would rise back to the level P1 associated with potential GDP. Since the economy was originally producing below potential GDP, any inflationary increase in the price level from P0 to P1 that results should be relatively small. The choice between whether to use tax or spending tools often has a political tinge. As a general statement, conservatives and Republicans prefer to see expansionary fiscal policy carried out by tax cuts, while liberals and Democrats prefer that the government implement expansionary fiscal policy through spending increases. Now, let's analyze an opposite case, which is an overheating economy where demand is so high that there is upward pressure on wages and prices, causing inflation. The original equilibrium is E0, which is an output level above potential GDP. In this situation, contractionary fiscal policy involving federal spending cuts or tax increases can help to reduce the upward pressure on the price level by shifting aggregate demand to the left from AD0 to AD1 and causing the new equilibrium E1 to be at potential GDP, where new aggregate demand intersects the long-run aggregate supply curve. When the government passes a new law that explicitly changes tax or spending levels, it is called discretionary fiscal policy. The 2009 and 2020 stimulus packages are examples. Changes in tax and spending levels can also occur automatically due to automatic stabilizers such as unemployment insurance and food stamps, which are programs that are already laws that stimulate aggregate demand in a recession and hold down aggregate demand in a potentially inflationary boom. Consider the first example before, where aggregate demand was to fall sharply so that a recession occurs. Then the prescription would be for expansionary fiscal policy with some mix of tax cuts and spending increases. The lower level of aggregate demand and higher unemployment will tend to pull down personal incomes and corporate profits, an effect that will reduce the amount of taxes owed automatically. Higher unemployment and a weaker economy should lead to increased government spending on unemployment benefits, welfare, and other similar domestic programs. In 2009 and 2020 recessions, the stimulus packages include an extension in the time allowed to collect unemployment insurance. The automatic stabilizers react to a weakening of aggregate demand with expansionary fiscal policy and react to a strengthening of aggregate demand with contractionary fiscal policy, just as the ADAS analysis suggests. The process works in reverse too. If aggregate demand has risen sharply, causing the equilibrium to occur at a level of output above potential GDP, this situation will increase inflationary pressure in the economy. The policy prescription in this setting could be a dose of contractionary fiscal policy implemented through some combination of higher taxes and lower spending. To some extent, both changes happen automatically. On the tax side, a rise in aggregate demand means that workers and firms throughout the economy earn more. Because taxes are based on personal income and corporate profits, a rise in aggregate demand automatically increases tax payments. On the spending side, stronger aggregate demand typically means lower unemployment and fewer layoffs, and so there is less need for government spending on unemployment benefits, welfare, Medicaid, and other programs in the social safety net. A combination of automatic stabilizers and discretionary fiscal policy produced a very large budget deficit in 2009 and 2020. The Great Recession starting in late 2007 and the pandemic starting early 2020 meant less tax-generating economic activity, which triggered the automatic stabilizers that reduced taxes. Most economists, even those who are concerned about a possible pattern of persistently large budget deficits, are much less concerned or even quite supportive of large budget deficits in the short run of a few years during and immediately after a severe recession. Each year, the nonpartisan Congressional Budget Office calculates the standardized employment budget. That is, what the budget deficit or surplus would be if the economy were producing a potential GDP, where people who look for work were finding jobs in a reasonable period of time and businesses were making normal profits, with the result that both workers and businesses would be earning more and paying more taxes. In effect, the standardized employment deficit eliminates the impact of the automatic stabilizers. The gap between the standardized budget deficit or surplus and the actual budget deficit or surplus shows the impact of the automatic stabilizers. More generally, the standardized budget figures allow you to see what the budget deficit would look like with the economy held constant at its potential GDP level of output. Automatic stabilizers occur quickly. Lower wages means that a lower amount of taxes is withheld from paychecks right away. Higher unemployment or poverty means that government spending in those areas rises as quickly as people apply for benefits. However, while the automatic stabilizers offset part of the shifts in aggregate demand, they do not offset all or even most of it. Historically, automatic stabilizers on the tax and spending side offset about 10% of any initial movement in the level of output. This offset may not seem enormous, but it is still useful. Automatic stabilizers, like shock absorbers in a car, can be useful if they reduce the impact of the worst bumps, even if they do not eliminate the bumps altogether. Because fiscal policy affects the quantity that the government borrows in financial capital markets, it not only affects aggregate demand, it can also affect interest rates. In this graph, the original equilibrium E0 in the financial capital market occurs at a quantity of $800 billion and an interest rate of 6%. However, an increase in government budget deficits shifts the demand for financial capital from D0 to D1. The new equilibrium E1 occurs at a quantity of $900 billion and an interest rate of 7%. A consensus estimate based on a number of studies is that an increase in budget deficits or a fall in budget surplus by 1% of GDP will cause an increase of 0.5 to 1% in the long-term interest rate. A problem arises here. An expansionary fiscal policy with tax cuts or spending increases is intended to increase aggregate demand. If an expansionary fiscal policy also causes higher interest rates, then firms and households are discouraged from borrowing and spending, as occurs with tight monetary policy, thus reducing aggregate demand. Even if the direct effect of expansionary fiscal policy on increasing demand is not totally offset by lower aggregate demand from higher interest rates, fiscal policy can end up less powerful than was originally expected. We refer to this as crowding out, where government borrowing and spending results in higher interest rates, which reduces business investment and households consumption. The broader lesson is that the government must coordinate fiscal and monetary policies. If expansionary fiscal policy is to work well, then the central bank can also reduce or keep short-term interest rates low. Conversely, monetary policy can also help to ensure that contractionary fiscal policy does not lead to a recession. The government can change monetary policy several times each year, but it takes much longer to enact fiscal policy. Imagine that the economy starts to slow down. It often takes some months before the economic statistics signal clearly that a downturn has started, and a few months more to confirm that it is truly a recession and not just a 1 or 2 month blip. Economists often call the time it takes to determine that a recession has occurred the recognition lag. After this lag, policymakers become aware of the problem and propose fiscal policy bills. The bills go into various congressional committees for hearings, negotiations, votes, and then, if passed, eventually for the president's signature. Many fiscal policy bills about spending or taxes propose changes that will start in the next budget year or would be phased in gradually over time. Economists often refer to the time it takes to pass the bill as the legislative lag. Finally, once the government passes the bill, it takes some time to disperse the funds to the appropriate agencies to implement the programs. Economists call the time it takes to start the projects the implementation lag. Moreover, the exact level of fiscal policy that the government should implement is never completely clear. Should it increase the budget deficit by 0.5% of GDP, by 1% of GDP, or by 2% of GDP? In an AD and AS diagram, it is straightforward to sketch an aggregate demand curve shifting to the potential GDP level of output. In the real world, we only know roughly, not precisely, the actual level of potential output, and exactly how a spending cut or tax increase will affect aggregate demand is always somewhat controversial. Also unknown is the state of the economy at any point in time. During the early days of the Obama administration, for example, no one knew the true extent of the economy's deficit. During the 2008-2009 financial crisis, the rapid collapse of the banking system and automotive sector made it difficult to assess how quickly the economy was collapsing. Thus, it can take many months or even more than a year to begin an expansionary fiscal policy after a recession has started. And even then, uncertainty will remain over exactly how much to expand or contract taxes and spending. When politicians attempt to use counter-cyclical fiscal policy to fight recession or inflation, they run the risk of responding to the macroeconomic situation of 2 or 3 years ago in a way that may be exactly wrong for the economy at that time. When an economy recovers from a recession, it does not usually revert to its exact earlier shape. Instead, the economy's internal structure evolves and changes, and this process can take time. For example, much of the economic growth of the mid-2000s was in the construction sector, especially of housing and finance. However, when housing prices started falling in 2007 and the resulting financial crunch led into recession, both sectors contracted. Many of the people who lost work from these sectors in the 2008-2009 Great Recession will never return to the same jobs in the same sectors of the economy. Instead, the economy will need to grow in new and different directions, especially with new technologies and increasing foreign competition. Fiscal policy can increase overall demand, but the process of structural economic change, which is the expansion of a new set of industries and the movement of workers to those industries, inevitably takes time. Furthermore, fiscal policy can help an economy that is producing below its potential GDP to expand aggregate demand so that it produces closer to potential GDP, thus lowering unemployment. However, fiscal policy cannot help an economy produce at an output level above potential GDP without causing inflation. At this point, unemployment becomes so low that workers become scarce and wages rise rapidly. A final problem for discretionary fiscal policy arises out of the difficulties of explaining to politicians how counter-cyclical fiscal policy that runs against the tide of the business cycle should work. Some politicians have a gut-level belief that when the economy and tax revenues slow down, it is time to hunker down, pinch pennies, and trim expenses. Counter-cyclical policy, however, says that when the economy has slowed, it is time for the government to stimulate the economy, raising spending and cutting taxes. This offsets the drop in the economy in the other sectors. Conversely, when economic times are good and tax revenues are rolling in, politicians often feel that it is time for tax cuts and new spending. However, counter-cyclical policy says that this economic boom should be an appropriate time for keeping taxes high and restraining spending. In conclusion, because of its limitations, fiscal policy is often used in extreme economic situations like an especially deep or long recession. For less extreme situations, it was often preferable to let fiscal policy work through the automatic stabilizers and focus on monetary policy to steer short-term counter-cyclical efforts. This is the end of this chapter. Thanks for watching and see you next time.